And let me just say that I am absolutely delighted to be up here, not only because of the event, not only because I get to see old friends and acquaintances, but because I think it's really important to have this sort of gathering at a rather special time in the global economy, and I'm going to explain. But when I heard John say he almost had a heart attack on Wednesday, I've been having a series of heart attacks leading to this event. And if he thinks he's been stressed, I've been really stressed. I've been stressed because of what the event is. I've been stressed because you're all pretty intimidating. And I've been super stressed because of the list of other speakers. And that was before I heard that Tom Friedman is a dinner speaker. So I want you to put yourself in my position and understand that I'm pretty intimidated up here. And I have to navigate stairs, so I may fall down the stairs in the middle of this discussion. I thought a lot about how best to provide you an opening presentation. How to provide you an overview, how to provide you a context for what's coming after me, and how to make it stimulating. And I struggled a lot. And then I remembered the advice given to a friend of mine who was looking to do a PhD at Oxford. And he was told the best way to do a PhD at Oxford is to apply to a certain school faculty and choose a topic that has nothing to do with that faculty. Because you're going to get the best examiners. So he applied to the School of Oriental Studies and chose an economic topic to do there as his PhD. And it worked. He would not have gotten his PhD had he done the economic topic at the economic faculty, and he certainly wasn't able to do anything at the School for Oriental Studies. But the combination was great. And that's what I'm going to do. I'm going to combine things. I'm going to combine theory and practice. I'm going to combine all sorts of disciplines, and if I succeed, I will give you a sense not just about what you should be thinking, but how you should be thinking. And I'm going to argue that the how today is as important as the what. And to prove it to you, I will take you behind the curtains at PIMCO and tell you that this is not just about words. This is influencing what we're doing. So that's the plan. The underlying theme is that we collectively are navigating some major secular changes that are going to play out over a number of years. We're doing it with a very narrow cyclical mindset. And we have to overcome the way we are wired as humans. So we have major secular changes going on. On the cyclical side, we're basically kicking the can down the road. We're not acknowledging them quickly enough. And it's okay because that's how we're built. Okay? We like to stay in our comfort zone. So let me start with the feeling today in the marketplace. There is three things that are dominating today. First is excitement. There's a lot of excitement. The Dow is at a record level. We've had 10 days of consecutive increases. If you look at CNBC, the clock, as they call it, which used to tell us how many days up to the fiscal cliff, is now telling us how close we are to yet another S&P record. And there's a sense of real excitement going on out there. There's also hope. There's hope that maybe this time around, it's not just a financial issue. Maybe this time around, the average person in the street will actually feel a lot better. Maybe this time around, we can get something that has eluded us since the financial crisis, which is high quality growth and a significant decline in unemployment. So you have excitement, you have hope. And then you have anxiety, a lot of anxiety. You have anxiety about what's happening in Washington. How can our Congress be so dysfunctional? You have anxiety about Europe. There's still a debt crisis going on there. You have anxiety about the central banks. They are so deep into experimental territory that no one can honestly tell you what the balance of benefit, cost, and risk is going to look like. So how do we reconcile excitement, hope, and anxiety? And what does it tell us about what's ahead? One of the techniques I learned as an undergraduate is the reduced form equation. That when you face complexity, the answer is not to try and explain it using 1,000 variables, because that will simply paralyze you. Instead, look for the reduced form. Look for some specification that has a small number of explanatory variables that actually allow you to do something about it. Granted, you're not explaining everything. You could be explaining 70, 80%, and therefore you have to recognize that, but at least you're explaining 70 to 80%. So I would suggest to you that if we took this approach today, there would be 4 things that you should worry about. And if you're planning your future, whether you're a company, a household, government, if you're planning your future, believe it or not, you're taking a view on these 4 things. So let's be explicit about them. And let's figure out what view we're taking. The first element is a process of economic healing. This country is healing. Look at the data. The majority of data confirm that we are gradually healing. From last Friday's employment number to this morning's industrial production number, from the housing market to the retail sector, what you're seeing is a gradual healing. It started with large companies. It spread to the housing sector. It spread to households. And even the government, with all this talk, is seeing an improvement in its budgetary situation. So if you look at the US, it is healing. Europe is a different story. Europe is healing, but only financially. So Ireland, after being shut out from markets since 2007, came back this week with a very successful €5 billion issuance. And the financial markets in Europe are well behaved. But it is not an economic healing, it's just a financial healing. The economy in Europe remains a mess. So the first thing you have to recognize is there is a process of healing. It's uneven, it's gradual, but it is there. The second element you need to recognize is the role of central banks. Central banks are carrying the majority of the policy burden today. Not by choice, but by perceived necessity. And this is a big difference. So not by choice, but by perceived necessity. You see this in the Fed. And we believe that the Fed pivoted in a really important way in 2010. It pivoted from something that it could deliver, because it had the tools, to something that it may be able to deliver, but it is using imperfect tools. Up to 2010, the Fed was focused on the functioning of markets. The private sector had gone too far. We fell in love too much with this concept of leverage, of debt, and of credit entitlement. And in the process, we delivered major market failures. And the Fed, in 2008, 2009, and the beginning of 2010, was focused on fixing markets. And it had the tools for that. In 2010, it pivoted to something else. It pivoted not to just fixing markets, but delivering economic outcomes. That is a completely different objective function. And here, early on, the Fed recognized that its tools were imperfect. So in August 2010, Chairman Ben Bernanke at Jackson Hole said it. He said, when you go unconventional, you have to remember not just the potential benefits, but the costs and risks. The Fed today is the equivalent of a pharmaceutical company that feels it has no choice but to bring the medication to the market, even though the medication hasn't been clinically tested. That is what the Fed is doing today. And that is why the Fed talks a lot about the cost of what it's doing, not just the benefits. But have no doubt that where we go from here is a judgment on whether the Fed will remain effective. Now, for financial markets, the Fed is great. The Fed is the equities market's best friend. Why? Because the risk markets happen to be right in the middle of the sequence from what the Fed is trying to do to what the Fed can deliver. And you cannot directly address the housing market. You cannot directly address the labor market. You look for an indirect channel. So let me say very simply what the Fed is trying to do, because this is really important. The Fed looks at fundamentals and says, they're down here, but I want them up here. I do not have the tools to get the fundamentals up here. And my colleagues in other government agencies are paralyzed. They're paralyzed by political dysfunction. And I, the Fed, have a moral obligation to do something about this. So I'm going to use the imperfect tools. What am I going to do? I'm going to take market valuations right up here. I'm going to force people like PIMCO, people like you, to take more risk. I'm going to push you into risky markets by putting interest rates at artificially low level. And my bet, the Fed, is that when valuations get up here, I trigger excitement, I trigger hope, I trigger animal spirits, and I trigger the wealth effect. And I get those elements to pull up the fundamentals. That is what the Fed is engaged in. And that is why people like us who say, but wait a minute, we are structurally impaired as an economy. Yes, we're out of ICU. Yes, we're out of the hospital, but we're still structurally impaired, and therefore we cannot run fast, believe that the Fed cannot exit this regime for a very long time. It will not willingly exit this regime. It may be forced to exit, and I'll come back to that, but not willingly. So second issue is the Fed. Third issue is what other countries have to do when the Fed is going unconventional. The US is the issuer of the reserve currency. The US is a supplier of all sorts of public goods. So most of the world cannot ignore what the Fed is doing. I travel around the world, and there is no doubt that from a conventional perspective, the Fed is being irresponsible. The question and the debate is it being responsibly irresponsible or irresponsibly irresponsible? Now that's, if you are on the receiving end of this, you have no choice but to follow the Fed. You have no choice ultimately but to become irresponsible. That is why Japan is in the midst of a major U-turn in terms of its monetary policy. That is why only last Friday, the Bank of Mexico had to cut 50 basis points, even though there is no domestic reasons to do what it's doing. Why? Because if you don't do anything, your currency appreciates. You lose competitiveness, you undermine employment. So the third element is how long can this game go on where the Fed is forcing everybody else to do something that they wouldn't be doing otherwise. And this is important because this is a very non-linear dynamic. And the fourth element is politics. dysfunctional politics. I don't remember a time when in the West, populations were losing confidence in the established political order. Now you see it very clearly in Europe. The Italian election was another example where people are basically saying that the traditional system doesn't deliver, but is not quite sure what does deliver. So you get paralysis. In the US, it's different. In the US, it's polarization. It's continued polarization. So we go from one crisis to another, and we never emerge stronger politically. Now, if you've done game theory at university, you'll say, of course you never emerge. Because the condition for a cooperative game to come out, a good cooperative game, is trust and enforcement. If you don't have trust and enforcement, you do not get a good cooperative outcome. You get all sorts of prisoners' dilemmas, everything else, and the process doesn't self-correct. And that's what we have right now. There's no trust in Washington, and there's no enforcement mechanism because rightly, we're nowhere near a crisis. So the politics, which is being ignored by the real economy, by the financial sector, not the real economy, okay, is going to get messier. And we have to understand that. So put all these four things together, what do they mean? In the short term, things look good. The economy is healing slowly. The central banks are giving you a tremendous tailwind. And the politics, yeah, they're messy, but they're contained. So in the short run, the markets will romance, the narrative will romance, things are really getting better. Over the medium term, and there's a big question, what does that mean? Is it months? Is it years? Over the medium term, there's a critical junction. It's a fork. And if you are a long-term investor, you better have a view on this. One is the handoff. It works. That central banks do trigger the wealth effect, do trigger the animal spirits. Growth picks up, employment picks up. The political system becomes less stressful because it's no longer a question about what do you take away, but it's a question of what can you give. And we transition in an orderly fashion from assisted growth to genuine growth. That is the handoff. The key issue and the key thing you should look is are healthy balance sheets, and there's many of them around the world, engaging in this process. Businesses whose investments pay off over 5 to 7 years with a tremendous amount of cash, are they putting money in investments or not? Long-term investors, are they willing to give up all sorts of liquidity, etc., because they trust the medium term? So if you want to judge how close we are to the handoff, don't look at the struggling sectors, look at the healthy sectors and see how are they behaving. Are they willing to engage their balance sheets? Because their balance sheets gives them tremendous optionality in an uncertain world. So that's one outcome. Now, if you're an investor, the implications are very clear. You want to be long virtually every risk factor. You want to be long the equity risk factor, the credit risk factor. You want to be willing to give up liquidity. You want to be long commodities. The only thing you don't want to be long is any government bond beyond about 7 to 10 years. But the other things, it doesn't work. That the four things that I've cited become problematic. That the healing never reaches critical mass. So it gets better, but it doesn't get better fast enough. So the economy in itself, endogenously, doesn't get to escape velocity. That central banks, and particularly the Fed, discovers that the costs and risks exceed the benefits. We have a whole list of costs and risks. They're very isolated right now. But at some point, they will get to a critical mass. Chairman Bernanke acknowledges this. He says, yes, I know that the money market sector has been destroyed. Yes, I know that the provision of life insurance to everyday citizens is becoming more problematic. Yes, I know that the functioning of markets is being impaired because I, the Fed, am no longer just a referee, but I'm also a player. Yes, I know that price signals are distorted. Yes, I know that I'm forcing people to do something that is not validated by fundamentals. Yes, 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 but all this is okay because the macroeconomy will improve. Well, if the macroeconomy doesn't improve, then all this is not okay. Now that issue gets amplified because we have an adding up problem. Not all countries can do unconventional policies. If you do, you end up with a currency war. So there's also a global problem. And finally, the politics. At some point, politics really matter. If you're in Greece right now, you know that because the person in the street has totally rejected the political system. If you're in Italy that's unable to form a government, you know that you can't implement reforms without a government. And if you're in this country, at some point we've got to make difficult decisions. And I'm really happy that Tom Friedman is coming tonight because he's going to list you the sorts of decisions we have to make because his theory, which is correct, is that average isn't good enough in a global economy. This second possibility has completely different investment implications. You should be saying thank you very much to what the markets have given you, and you should be exiting. You should be very careful about tying up your money for a long time because the optionality that cash gives you is enormous. Yes, it's at negative interest rate, but you have optionality, and you should never underestimate what optionality buys you. And instead of hating the long end of the bond market, you should be loving it. That's your reality. That's our reality. In the short term, a lot of clarity, and then we are going to be forced into one or the other. What does it mean? It means you've got to think not just carefully about what you're doing, but you've got to recognize that you're probably hostage to a mindset that will not recognize quickly enough this major change, that will not pivot quickly enough from very short-term cyclical issues to secular issues. We've spent a lot of time over the last few years on behavioral finance issues. We spend a lot of time understanding the unconscious biases that we all are victim. And there's nothing wrong with unconscious biases. It's the way we're wired. But these unconscious biases are blind spots when you are trying to navigate this unusually uncertain outlook. Bernanke's term, unusually uncertain. Let me give you an example. We brought in a professor from Harvard, Professor Banerjee, who just came out with a book on blind spots and unconscious bias to talk to us about these issues. And we were sitting, we brought the firm in, and we did it first in Newport Beach, where we're based, and we did it in New York, and then we took it to our European offices and our Asian offices. And we basically more than encourage our people to go to this. We basically forced our people to go to this, nicely. Huge resistance. Taking someone off the trade floor, okay, and taking someone off the trade floor to speak about something so soft, okay, is like a crime at PIMCO. And I was sitting in a table over there with our financial analysts, our financial engineers, and they were absolutely convinced that they can never be subject to unconscious bias. Maybe our marketing people can, but not us, the financial engineers. And you could see, you know, they were sitting like this, huge resistance. And Professor Banerjee took us through experiment after experiment that was very disturbing to the people sitting there. Very disturbing. Because we kept on getting it wrong. And at PIMCO, you don't like to get something wrong. And then she said, okay, and my room was absolutely convinced that there was something going on there. I'm not going to tell you what they are. They're on YouTube, by the way, but they're worth taking. And then she said, okay, I can see that you're not all convinced, and I will talk to you about the science of this in the second half, but you're not going to listen to me about the science if you're not convinced that you are subject to unconscious bias. And then she brought out an overhead projector, and she had to explain to people what an overhead projector was because half the room had never seen it. So she comes with this overhead projector and puts a transparency that has two figures. And she asked the room, how many people believe that these figures are the same? Nobody raised their hand. Nobody. She then took a second transparency. She fitted over the first thing and then took it up, and it fit exactly over the second one. And there was a ah in the room. And then she said, if anybody doesn't believe what they just saw, come up and do it yourself. And my table all came up, lined up, and did it. Now, why am I telling you this story? Because we as human beings are wired to function in a certain way. And it serves us extremely well. We're wired to believe in mean reversion. We're wired to believe in bell curves that are pretty well behaved. You know, these normal distributions are very comforting. There's a high probability of a certain outcome, and the tails are thin. So we know how to behave. When our plane is leaving at 5 o'clock, we know it could be late. We know it could be a great flight, okay, empty, you get served really well, but that's not our major expectation. Our major expectation, it will take off at 5, and we know that we have a certain behavior. That is not the world we're living in. The world I described to you is a much flatter distribution with much fatter tails. That requires a different type of behavior. It's the equivalent of me telling you, you know that flight that you thought was going to leave at 5 o'clock? Well, it's either going to leave at 9 a.m. or 9 p.m. That's what that distribution looks like. You've got to think differently. So in addition to being very careful of how you position for the long term, you also got to start questioning a lot of things that you take for granted. In my world, let me give you an example of what that is. The first thing is labels. We humans love labels. They're shortcuts. They contain enormous information. So let me give you an example. In my world, there used to be a very comforting label: advanced countries and emerging countries. An advanced country was mature, lived in cyclical space, had limited default risk, and was mainly influenced on the interest rate side by monetary policy and growth. A developing or emerging economy is completely different. Immature institutions, lives in structural and secular space with high default risk. My industry has a whole architecture based on these two labels. Benchmarks, asset classes, conventional wisdom based on that. That's not the world we live in. The advanced countries are not a cluster, they're a whole range. You have Germany that is truly interest rate risk, and you have Greece that's default risk. The emerging world has become a whole range. China, Brazil, Mexico are no longer default risk, but Zimbabwe is default risk. Labels dominate a lot. Call your financial advisor, and they have these labels dominating your asset allocation. Correlations are breaking down. Of course they're breaking down because the Federal Reserve is now a price setter in markets. So suddenly you find that diversification no longer gives you the risk mitigation that you expected. You've got to think differently about risk. And finally, you've got to think differently about your human talent. I was among the first readers of Sheryl Sandberg's book. It was sent to me by 2 colleagues because we have discovered that we used to do really silly things that limited our ability to include different perspectives in our decision making. I'll give you a very simple example. We were interviewing a woman, this was 5 years ago. We were interviewing a woman that we really liked. We had 2 days of interviews. We were convinced she was going to join us, and she really liked what she heard. And then she decided not to join us. So I made the phone call. I said, look, I'm not trying to change your mind. I just want to understand why, because we were under the impression. He said, and she said, you know what, you were absolutely under the right impression, except for one thing. I go, what's that? She said, you know how many interviews I had with you? I said, a lot. She said, I didn't see a single woman on the other side. So I called our HR department. I said, how do we specify the interview list? And they said what you would expect them to say. First, expertise. So we pick people who can test that person's expertise. Second, cultural fit. So we pick people who can do that. Thirdly, conveying information. And I said, well, when we put it all together, do we ask the question of what does it look like from the other side? Of course, we never did. And then we started discovering a lot of issues that we do that inadvertently hold back our own talent and hold back our own perspectives. So the last message I want to give you with, if you're going to navigate this world, exploit in a positive way your ability to get talent. Because you need an enormous amount of talent, and you need to be able to think differently and force yourself out of your comfort zone because of this massive inconsistencies between what's happening secularly and what's happening cyclically, between what's happening in the dynamic real economy and what's happening on the political front. Let me end and open it up for question with this simple observation. There is a reason why Ben Bernanke coined the phrase an unusually uncertain outlook. Not just uncertain, but unusually uncertain. There is a reason why we all feel great today, because we are in this sweet spot where economic healing, enormous stimulus by central banks, and noisy but not influential politics when it comes to what the financial markets think about. All these 3 things have combined to create a perfect positive storm, but we have a major, major fork ahead of us. And no one knows for sure which way you're going to go. But what I would suggest to you is that unless you start thinking secularly and start thinking about all the things that you take for granted, the probability of not recognizing early enough which way we're heading increases significantly. Let me stop here, and I'm very happy to answer any questions on any topic. Thank you very much.
Thank you very much, Mohamed. Mohamed doesn't know this, but he manages my life savings. And so I had a different kind of anxiety coming in this morning, which has been completely solved. In A Midsummer Night's Sex comedy, Woody Allen played a stockbroker, and somebody asked him what he did for a living. And he said, I manage other people's money until it's all gone. and so that's, some of my best friends are asset managers, so that's not a condemnation. I think you already answered this question. Normally, it's my job to ask the first question. But I think you asked the question, and you may have answered it, and you said, where we go from here depends on whether or not you think the Fed is going to be effective. Or it depends on whether the Fed is going to be effective. And it may come as a surprise to you, but there are several people in the audience who are critical of current Fed policy. And so what is your answer to that question? Is the Fed going to be effective, in your opinion?
So you've got to ask effective in doing what? Will the Fed continue to be effective in buying time for the political system to get its act together? Will the ECB continue to be effective in buying time? The answer is yes. Why? Because unlike developing countries, you cannot force the Fed out of its current approach. Three things force smaller central banks out of the irresponsibility that the Fed is now pursuing. A currency crisis, an inflation scare, and a political breakdown. It is very difficult to get a currency crisis when you're the issuer of the major currency, of the reserve currency, and when other parts of the world aren't doing particularly well. Remember, you cannot replace something with nothing. There is no other currency that can step into the role of the dollar. So you're not going to get a currency crisis. Second, could we get an inflation scare? Yes, we could, but the economy still has idle capacity. So it's actually very difficult to generate the cost plus inflation that would really disrupt inflation expectations. And will the political system focus on the fact that the Fed has become a quasi-fiscal institution and not a monetary institution? No, because the political system is too busy dealing with all these other crises that it creates. So if the question is, will the Fed be effective in buying time for the system so that others can get their act together? The answer is yes. Now, there's a qualifier. It's not a free lunch. It comes with a lot of costs and risks. It's come with a lot of collateral damage and unintended consequences. If you ask the stronger version of that question, will the Fed be able to deliver its economic objectives? The answer is no. That's how we feel. No, it won't. Because in order to deliver an unemployment rate below 6.5%, which is not because people drop out of the labor market, but because people have jobs, in order to deliver a competitive industry a competitive country that can grow sustainably at 3.5%, in order to catch up with what we have left behind since the crisis, you need to deal with the structural impediments. And you cannot do that if you're the Fed. You do not have the instruments. So yes, in buying time, no in delivering what the economic outcomes that we all want. The Fed needs help from other agencies and from a political system that actually has the right tools.
Okay, thank you. Questions? Question back here. You need to. Someone will bring a mic to you.
Thank you, Zach Shemerk. Just following up on the latest you said, whether the Fed is going to be effective in buying time. Sure, that may apply to economic growth, but if you think about the sustainability of government deficit, isn't the Federal Reserve providing a disincentive to engage entitlement reform by helping to finance government debt? And so isn't the Fed's policy in that sense counterproductive? Is that just part of the potential risks and so forth? Or could one make the argument, no, by buying time, actually they're very counterproductive because politicians will only act if they're forced to do so by the bond market, which of course may not happen if the Fed is so active.
So your question is a really important one, and I think it's very important to understand what regime we're in, what monetary regime we're in. When you have an excessively levered economy, which is still our reality, the best way to safely delever is through economic growth. Economic growth allows you to maintain living standards and pay back unsustainable debts. For the reasons that we've discussed, okay, we're not going to get that sort of economic growth. So if you are in that world and you still want to safely delever, well, you can default, like Greece did, but that's not safely delevering. You can impose austerity. That's what the United Kingdom is trying to do. But we, for many reasons, hate the concept of austerity. Europe is very different. You go to a German or an Austrian, they believe austerity is, quote, cleansing. Okay, we will do anything as a society to avoid austerity. You can do what we're doing now, which answers your question, which is financially repress people. And that's the regime we're in. We're in a financial repression. Financial repression is a very hidden tax. You keep interest rates artificially low, and the Fed is using 3 unconventional mechanisms to keep rates artificially low. It is first and foremost keeping the policy rate at a very negative level. Second, it's giving forward guidance in a way that stretches credibility. And the third is buying assets. It's using its balance sheet. Now, why is it important that it keeps interest rates artificially low? Because you tax savers and you subsidize debtors. Now, one of the debtors that's being subsidized is the government. Right? Yes, the government is being subsidized. The government is being able to issue, okay, at levels that are inconsistent with the underlying conditions. And the only reason it's being able to do so is because the Fed is keeping interest rates artificially low. Two consequences, one good, one bad. The good consequence is that you buy time for the system because savers do not revolt. Savers don't take to the streets, okay? You can run a financial repression regime for a long time, and we have in the past. We have, okay? And that's, you know, the book by Reinhard and Rogoff speaks about that. But the other thing is you force a resource misallocation. It's not just among the governments, among all of us. Okay, we are doing things today that we would not be doing if rates weren't artificial. Right? We are being pushed, and that's the word Bernanke used, pushed into certain activities. It's like a marriage. Would you rather be pushed into a marriage or pulled into a marriage? If you're pushed by your parents, okay, the probability of success of that marriage are lower than if you're pulled by the attractiveness of the marriage itself. So yes, that is one of the cost and unintended consequences of that, is that the resource misallocation is not just in the private sector, it's in the public sector. But the bet that the Fed has on, and the bet that we collectively have on as a society, is that somehow we will be able to kick the can down the road long enough until the system itself either heals very quickly, and there are those who at PIMCO, there are those who believe that that will happen, that the system will endogenously heal very quickly, and or our politicians will get their act together.
Other questions? Back here?
Could you elaborate on the currency wars that you talked about earlier and what implications it has on trade between countries?
So if you want to get people upset, and John Lipsky is here, and he can give you a much better view of what these two words imply to people. Okay, go to Washington and say currency wars, or go to a G20 and say currency wars, right? Our traditional characterization of a currency war is a trade-driven phenomenon. Okay, so we have a massive trade imbalance. It cannot be sustained for long. So people start using the currency as a way to capture market share. Those who are losing market share say, hell no. They start using that currency. And since a currency is a relative price, you have a massive inconsistency. So today, people are, even the most diplomatic are saying, we don't have currency wars, we have currency tensions. Now, the currency's tensions are the following. In trying to use monetary policy to compensate for structural policies, you have to go through the exchange rate. Why? Because the system is not able to absorb all the liquidity that's being put into the system. It's structurally unable to absorb it. So when the Fed, I'll give you a perfect example, when the Fed takes interest rates to artificially low levels and pushes you to take more risk, your broker will say, hey, you know what? Have you thought about investing in emerging markets? They offer you an upside, and I know it's more risky, but you know what? They pay you so much more than what you paid here that you take the risk. So what do we collectively do? We start investing in the rest of the world. The rest of the world sees all this money coming in that has nothing to do with their situation. This is money that's being pushed out of the US. And the first reaction is benign neglect. It's okay, money is good. And then the currency starts going up. They start losing competitiveness. And then their financial system starts misbehaving. And they say, we don't like this. So they try to stop it. And ultimately, they are forced, like Mexico has been forced, like Brazil has been forced, like Korea has been forced, like Japan has been forced, into doing exactly the same thing the Fed is doing, which is take interest rates very low, so to reduce the incentive that you have. So that is why we have these currency tensions. Now, it's really interesting because this issue came up at the G20. And the G20 communique was wonderful because it said, we are okay with what Japan is doing. And remember, Japan has moved its currency by 20% against the euro, by 20%, since it signaled that it's changing. And the last thing Europe needs is a stronger currency. Right? So the G20 response was, we're okay because they are pursuing a domestic objective. They're not trying to change trade. Now, if you're charitable, you say, well, this is yet another indication, right, of the kick the can down the road, let's try and keep the game going for a while because we can hope that at some point we're going to address our fundamental issues. That's the charitable interpretation. The less charitable interpretation is that there isn't sufficient understanding because it's not your classic currency war, it's a very different type of currency war going on.
We have time for a yes-no question. Yes.
My question is, it relates to the dividend yield on the S&P 500, which is currently hovering and dangerously close to going below 2%. If we look at 170 or 150 years of history with the dividend yield on the S&P at or below 2% or whatever popular market average, the next 10 years shows returns ranging from negative territory to perhaps the very highest of 3 or 4%. How can we justify looking forward to perhaps a better return than that over the next 10 years? Is that any relation to the artificially low interest rates?
Yes.
Do you want to expand on that, or you want to write that?
Let me just say, every financial asset is artificially priced. Every financial asset. Why? Remember that simple image. So unless the fundamentals validate, then yes, what we've done is we've simply borrowed returns from the future. That's all we've done. We've borrowed them from the future, just like we borrowed growth from the future. And therefore, it is very difficult to sustain the 7-8% that we've grown up to believe that that's the case. And the 3 to 4% is probably the most optimistic, okay? Unless the immaculate growth happens and we validate all this. Thank you very much. And I'm going to do something that I used to hate doing, okay? Which is see a speaker, get up, speak, and leave. But I really have got to get back to work. I've got a day job. And since I heard that his whole savings are with us, you can imagine. So thank you very much, and have a wonderful day. And thank you for inviting me.
Thank you, Mohamed. Thank you. It was wonderful. It was wonderful. Thank you very much.